All right, let's jump right into it. Today we're going to break down a moment that every single trader faces. It's a classic decision point, and we're going to see how using pivot points can help you navigate it when you're trading breakouts.
So, imagine this. The chart is lit up. The price is just screaming towards a major resistance level. Your heart starts pounding. What do? Do you hit the button and jump in right now, trying to catch what could be an explosive move, or do you wait? Do you let it play out a bit, looking for more confirmation? That right there, that's the big question.
And this is where pivot points become your best friend. Think of them as your roadmap, highlighting these critical battlegrounds between buyers and sellers. And when one of those levels gives way, that breakout, well, that's your signal. That's your moment of opportunity. The real trick is knowing how to play it.
And that really leads us to a fork in the road. There are two main ways to think about this, two strategies you can use. There's the aggressive approach, and then there's the safe approach. Neither is right or wrong, they just come with a completely different set of pros and cons.
So here's the deal, the essential trade-off you gotta make. If you go the aggressive route, you're trying to get in on the ground floor. You want to catch that first explosive pop, but the huge risk is getting faked out. On the flip side, the safe method is all about patience. You wait for more confirmation, which gives you a much better shot at a winning trade, but you might miss out on that initial big move.
Okay, let's make this real. Look at this Euro-USD chart. Here's a moment where being aggressive would have paid off, big time. The price just slices right through R1 and then R2 resistance. An aggressive trader who jumped in on those breaks would have caught a massive, super fast rally. I mean, that's the dream, right?
But, and this is a big but, look what happens just a little later at the R3 level. An aggressive trader sees the price punch through again and thinks, here we go again. They jump in and bam, it's a trap. A nasty fake out. The price completely rejects the level and snaps right back down. That is the painful reality of the aggressive method.
But check this out. This is where the safe method is just brilliant. That same R3 level that trapped the aggressive trader becomes a golden opportunity for the patient one. Instead of buying the initial break, the safe trader waits. They wait for the price to pull back and retest that broken level, giving them a much stronger, higher probability signal to get in.
So what is this retest all about? What's the magic behind waiting for it? Well, it all comes down to a really cool and fundamental concept in technical analysis. It's the secret sauce behind the safe method, and it's called role reversal.
It sounds kind of technical, but the idea is super simple. All it means is that what was once a ceiling often becomes the new floor. Once a resistance level is broken in a convincing way, the market's psychology shifts, and traders start seeing that same level as a potential area of support. The roles have reversed.
And you can see it playing out perfectly right here on our chart. Look closely at that R3 level. The price breaks above it, then falls back down to it. And what does it do? It bounces. That old resistance, that old ceiling, is now acting as a new floor of support. That's role reversal in action, and it's a beautiful thing to see.
Okay, so the theory is making sense. Now let's get down to business. Let's get practical. How do you actually use this to set up a trade? Where do you put your stop loss? Where do you take your profit? Let's open up the toolkit.
It's really a simple three-step game plan. Step 1, you spot a clear, decisive breakout of a pivot level. Step 2, you place your stop loss, your safety net, just on the other side of that level you just broke. It makes perfect sense, right? If the price falls back below it, your whole idea for the trade is probably wrong. And step 3, you set your target. The most logical place? The very next pivot point.
Let's walk through it on this chart. The price breaks above R1, so your stop loss goes just below R1 at what we're calling stop A. Your target is R2. Now let's say that works out and the price breaks R2. Awesome. You can now move or trail your stop up to just below R2 at stop B, and your new target becomes R3. See how you're logically managing the trade as it progresses?
Now hold on. Before you get too excited and start looking for breakouts everywhere, we have to talk about the risks. We need a serious reality check here, because no strategy works 100% of the time, and trading breakouts has some very specific dangers you absolutely need to be aware of. Okay, risk number 1, we've already seen it in action, the dreaded fake out. It's the most common trap. Risk number 2, news. A big economic announcement can just throw all technicals out the window and cause insane, unpredictable spikes. And risk number 3 is a little sneakier, hidden levels. Just because you broke a pivot point doesn't mean you're in the clear. There could be a much stronger historical price level hiding just around the corner, waiting to stop your trade cold. So what's the lesson here? The biggest takeaway is this: never ever use pivot points in a vacuum. They are incredibly powerful, but they're not a crystal ball. Your odds of success go way, way up when you combine them with other tools. You want to see confirming candlestick patterns, you want to see momentum building on your side. The more evidence you have, the stronger your trade.
Which brings us right back to the beginning. We've gone down both paths now. You've seen the aggressive, high-risk, high-reward approach, and you've seen the patient, higher probability, safe approach. You know the mechanics, you know the risks. So the only real question left to answer is, which path is right for you? Which type of trader are you?